Hello and welcome to Smart Beta, our section on how wealth managers intelligently use passive products within their portfolios. Joining me today is Richard Bonnor-Moris, Head of Multi-Asset Solutions at Newscape Capital Group. Tell me, how do you use passive products within your portfolios?
At Newscape, we tend to have about a third of our assets in passive. Essentially, we do believe in active managers. We do believe that there is value and alpha to be added, but beta products can be very useful for when we want to either have short-term investment into traditional equity or fixed income investments, or where there aren't active exposures or active managers available. For example, we use passive investments for commodity trading quite often in the short term, or even for currency trading, things like that.
So if you could pick out some of the key advantages of using passive products within your portfolios.
Everyone talks about cost when it comes to passive. They are cheaper than active managers, cheaper insofar as they cost less in terms of total expense ratio. They also give you exactly what it says on the tin. You know, you don't have, if you're going to hold something for a short term, you want to know what you're going to be holding. With an active manager, you don't necessarily know that. And with a passive manager, you can hold them just for a short period of time if it's just that beta that you want, whereas an active guy could easily have changed the allocation not to reflect the pure beta bet that you want to put on.
And what do you feel are the disadvantages of passive products?
It's just the cost. A lot of people talk about passive investments as a purely low-cost solution, and I guess that is the case. Apart from if you take into account alpha, and alpha does exist, and we believe in alpha at Newscape. Most of our managers have added alpha over and above what a market index may provide. A passive investment will never give you more than what the index is giving you, less the cost, and those costs are getting down, and that's why it's becoming more and more attractive. And the game is getting harder and harder for an active managers to beat them. But at the end of the day, if you're going to hold something for a long term and you believe in active management, we do prefer to hold active managers over and above pure passive investments.
Have you felt an increasing need for the use of lower cost products ahead of the RDR?
Yeah, I mean, the regulator is very much encouraging people in their rules about treating your customers fairly to move towards just the lowest cost in terms of total expense ratio. Now, you know what that is when you start to invest. And for an active manager, that is a higher number on the whole than a passive manager or a beta manager or investment. But what you can't take into account is what the alpha is. The FSA don't let you. We have huge amounts of experience of managers adding far greater excess return than you could ever achieve in even by buying the index, which you can't buy. But you know, from a passive investment, it to us is an easy argument to make. However, the FSA don't seem to take into account true cost, which is at the end of the day what the investors should care about.
Okay, thank you for your time, Richard.